Hi, my name's Roger Schluter. The video today is really on the short business loan proposal. And I'm putting new behind it. I'm saying, I'm not going to put new in front of it, but I'm saying the short business loan proposal new. Because I do have a video on this, and this is going to be the new and improved short business loan proposal. It'll be very similar to the other one, but if you watch this one, you will admit that you will like it a lot more, and it has a little bit better information. So anyway, the short business loan proposal is an important tool to use when you're talking to a bank about a business loan. I've been a banker, and I've had people come in, and they give me this book. It's this thick, and it's 200 pages. It's a business plan, and I'm sitting there, and they think I'm going to spend my whole weekend reading 200 pages. I don't think so. So anyway, I'd take it and I'd flip through it, and I'd turn to about 5 to 8 different things. I'd basically look at the costs, what they're going to finance. I'd look at their personal financial statement. I'd look at any financial statements they had. I would also look at projections, if they had any projections of future year's business. And of course, any financial analysis that was on it, I would read. And I might look, if they had a little history part in the beginning, I'd kind of look over that. And of course, if they had a summary in it somewhere, I would definitely look at that. But, I'd be flipping through this, and I know the person what they're thinking. They're probably going, what's he looking at, and what's he doing? But anyway, I just look at those few things. So anyway, the short business loan proposal, it basically gives the lender all the information to get your loan approved. The best short business loan proposals will give the lender the information in such a way that he can go ahead and write his own credit memo. And that's really good. And that's what bankers want to do. They want to take your information and they want to put it together in their form to go ahead and get the loan approved. They usually have somebody to answer to. I know very few people that are bankers that actually have an authority. They would call it an authority to lend, of how much money that authority is. So they would say, oh, I have an authority of $1 million. Well, then they could lend up to $1 million. But normally, I think usually they run it by somebody or take it to some board or some group. Because they don't, if this goes out of business, they don't want to hang there themselves. They want to say, whoa, all these guys, they all agreed. That was a good deal. So anyway, and a lot of times, if I was doing it, if I was the lender and they brought in this stuff, I'd basically go through it and copy and paste, if it was in the form of like an email or something, I would go ahead and just copy and paste on it. Other than that, I would just verbatim take information they gave me if it was accurate. And I'd use that to write up my own credit memo to get your loan approved. So, it was just that in it, and it saves you time. I mean, I remember so many Saturday afternoons after I met with somebody that week, a couple people, and I'd be writing up loans on a Saturday afternoon, and it's 80, 90 degrees out, and everybody's having a good time. And I'm sitting there writing these things up in the office or something, and that's not where you want to spend your time as a lender. So anyway, in this short business loan proposal, there is 8 parts. The first part is the history and the history of the business and the management of the business. An existing business, everybody uses SBA standard. An existing business is a business that's been in business for 2 years, 2 years or longer. If it's been in business less than 2 years, it's a new business. It's not an existing business. So anyway, on the existing business, what they'll include is kind of really, since it's already a business, what the business does, how long they've been in business, who owns the business, the competition, the company advantages of doing this type of business. And then on the management is not as important for an existing business because you have all that history, all that sales and earnings history. So management is not as important for an existing business. They just want to know, it's done by whom, the management, the day-to-day management is done by whom, the qualifications of those people. And sometimes the owner, he worked in the industry for 20 years. So that's his his management or his qualifications of management. And that's good too. So, normally if that's the case, we always say, he ran this business for X number of years, or he ran a business like it. So, and that's usually fine. Now, a new or startup business, they have to show the ability of the owners to run to run the day-to-day operations of the company, as well as the financial accounting and financial planning. The startup has no history. So you really want to talk about the business products, the service, what you're in business for, how your business will make money. You really want to talk about those things. On management, on a startup, you have to elaborate on the education and training, talk about management courses, or talk about real life experience that you've had that really helps you in this business. The real life experience in the past, or did you learn on the job? Did you work for somebody else for a period of time and thought you could do better or do this the same? So anyway, who will do that day-to-day management and past experience? If you worked in a field, for X number of years, that'd be good. And who will do the financial accounting and planning? Now, a lot of times, if you don't have any experience in that, you can say, well, I'm going to use my accountant. I'm going to use my CPA, for this purpose. This CPA or this accountant gives good guidance, and it has helped many businesses in the past. So they're going to help me through the financial part of it till I, get myself up to speed. So anyway, that's really the management and the history. Now the second part of this is the project cost and description. And, existing or startup, they both need this. They need a list of the cost. And basically you want to put it on a uses and sources form. So basically you list the uses on this side, and then the sources over here. Uses are what you're going to use the money for. Sources are where you're going to get the money. And hopefully those two will match. They're supposed to match, the numbers are supposed to match the totals. So anyway, the uses list, like I said, is just, we're going to buy this equipment, we're going to spend this much on this, spend this on this. It's really what your total project cost. And then you can document that, and you need to document it, especially either or existing company or a new company. You want to document it. You want to go ahead and describe it as well as you can and document the cost. Now, this can be a bid from a supplier, or it can be just like some piece of equipment pulled off the internet with a price on it. So anyway, either of those would work, for the project cost and description. But you really need that, and I would be as descriptive as possible. Sometimes the banks, if a banker is really I guess if he's really trying to impress somebody, he may go ahead and try to look these up himself to see if your costs are really accurate. But you want to get as close as you can. They don't want you pulling it out of the air, but if you have some basis for the cost, and it's not totally perfect, that's fine. As long as you do have a basis for the cost. Now, the third item in the short business loan proposal would be the personal financial statement. And with that personal financial statement, you do need to run your own credit and come out with a credit score. The personal financial statement should be either on the bank form that you're going to, and you can usually get one in one of the offices. If you know which banks you're going to go in a branch somewhere and say, hey, I need a personal financial statement to fill out to show to one of your lenders, and they'll give you one. Or you can use SBA's form, which is very, very good. The bank's forms are a little bit easier to fill out usually. SBA's form is very comprehensive. You want to make sure this document is signed and dated. You wouldn't believe the people that give you a personal financial and it's not signed and it's not dated. And this could be from 5 years ago. You never know. But you want it dated, and you want it rather recent. You don't want to take one that you used a year ago. With SBA, you got to have one within 90 days. So, and I would just give them one within that week or that month or something. And you do want to run your credit. And if you have to pay for the score, get the score, you want to know what your score is, because a lot of times bankers aren't going to look at your whole credit and analyze it and everything. They're just going to look at the score. And now sometimes if the score is kind of low, they might ask you about it, or they may look at to see exactly what it is. Usually in banking, usually things like cell phone bills and hospital bills and things like that, they're not concerned about that. So if you got a low score because of those things, they're like that. There's a lot of things that happen in those areas that really aren't the fault of the borrower. He's not trying to not pay. He's just had some things happen. So anyway, you really want to get that score. You can always go to Credit Karma, and I'm sure there's probably by now a couple other entities like that will give you a score. Sometimes these won't be an exact score. I found my Credit Karma wasn't exactly like my TransUnion, but it was very close. So as long as you're close, you're fine. And they do give a pretty close score. So I have used them before. I have told other people to use Credit Karma before. And so that's about it for the personal financial statement. Try to make sure and on all of these things, I'm actually going to have other videos on it. So I've got a video on the personal financial statement that really kind of goes over it in more detail and actually kind of tells you what you can get away with and what you can't. And I've got them for the other things too, for the history. I've got one for the cost, the personal financial, and all down the line, all 8 items. So anyway, the number 4 is financials and the cash flow of the business. Now this is basically existing companies, because if you're a brand new company, you're not going to have past financials. So anyway, you want to put those financials on a spreadsheet, and you want to do them from basically left to right. And left would be the older ones, to the right would be the newer ones. And you want to, because the bank's going to want to compare these numbers for these different years. So basically you really want to do your P&L. Banks don't care as much when they're doing the loan as the balance sheet. They will look at them, but they're more concerned about your sales and your earnings and your expenses. Want your sales going up, and want your earnings going up, they want your expenses to stay kind of steady, or at least a percentage of sales. So anyway, you also want to include a cash flow. And in a P&L, I mean, basically, the cash flow is basically you're adding in any non-cash charges. And usually depreciation is the big one. That's a non-cash charge that's a lot of times on the income statement or profit and loss statement. And there could be some other ones, but I mean, you want to add back those non-cash charges. And you want to do a debt service coverage ratio also for all the years. And I do have on the video on financials and cash flow, it does cover how to do the debt service coverage ratio. But basically it's how many times your cash covers your debt. And so anyway, banks will want a 1.2 to 1.3 times. That means you have 1.3 times the cash of your debt. So you want to have more cash than debt, because you don't want to be going backward. So anyway, higher the better. SBA has a little lower bar. Their debt service coverage ratio has to be at least a 1.1 or better. So anyway, that's about it for the financials and cash flow for the existing company. Now, number 5 is the projected financials and cash flow of the business. Both the existing and the startup both need to have projected financials and cash flow of the business. It's most important for a startup because you don't have anything else to go by financially. And then the project profit and loss, you want to do it for 3 years. You do want to show, the debt service coverage ratio on this also. And that projected profit and loss. You want to, just like the existing company did it from left to right in a spreadsheet for each year, you want to do that same thing for at least for 3 years. And some SBA programs will only ask for 2, but I would just do 3 because all banks usually ask for 3. So anyway, on the startup, you also want to have a projected profit and loss monthly for your first year, and that is very important because if they end up going SBA, they're going to want to see that also. So anyway, it's just the same as the projected P&L, only instead of doing it for years, you're doing it for 12 months for 1 year. And what they want to see there is that if there's any seasonality, that you've taken that into consideration, and they just want you to be able to see that you can make it that first year, really month by month. And no matter what, whenever you're doing projections, you have to have assumptions. And I get so many, everybody does lending. You get projections that are just numbers on a sheet, and it doesn't say anything how they got those numbers. You have to have assumptions, and assumptions is, how did I get these numbers? And you really want to be detailed on that. How did you get the sales number? What is the cost of goods sold based on? Is it a percentage of sales? And all your expenses. I mean, how did you come up with them? Some would be easier, like if you've already got a location you're renting, then you'd have a certain square feet, and you could probably go to your electric company and say, what's my average bill going to be, and then give it to you. So a lot of stuff you can come up with, but do have a list of sales, cost of goods sold, and then all your expenses that really detail how you got those numbers that went on that projection. And that'll go a long way in getting you the loan, believe me. Number six is the financial analysis. Now, most of you are not going to be MBAs, you're not going to be CPAs, so financial analysis of financial and projections showing trends and ratios of the business, that's kind of what you need. They kind of show how you will pay off that loan. If you get an MBA or a CPA or accountant, they can usually do these for you. But basically they're looking at financial analysis is looking at your sales, the trends of your sales, the trends of your expenses, the trends of your earnings, and looking at the trends, looking at a lot of the ratios, and really looking at all this, is going to show how you're going to pay off that loan, because when things going the wrong way. I mean, and usually it's kind of like in appraisal, they used to say made as MIA appraisal, made as instructed, or made as whatever. And it's kind of like that. I mean, if you're doing projections, you don't want to do them to show you're eventually going to lose money. You want to make them sure that you're making more money every year. And most banks know that, so they know you're going to fudge a little bit. So, but anyway, the financial analysis really analyzes the financials or the projections and analyzes them in such a way that the bank understands, that your business is going to be able to pay off the loan. Really, that's about it. And I do have a video on that too, on that, and then on number 7, the collateral, and number 8, the summary. So anyway, those would be good to watch if you don't understand something like the financial analysis. I've got an MBA. If I didn't, I'd probably want to watch one of those videos for the financial analysis. Number 7 is the collateral, and what is the collateral for the loan? Is just the assets that are backing up that loan. It's what the lender can sell to pay off the loan if you cannot pay off the loan. So collateral, most banks want collateral. SBA will also want collateral. So it just depends. And a lot of times SBA banks use SBA to cover when there's a shortfall of collateral, or if there's a shortfall of equity, and there's a shortfall in something or something, one area that needs kind of a, kind of lifting up. A lot of times they'll use SBA to fill that void. The SBA guarantee can cover up a lot of mishaps and things, that could happen with the business. So collateral, you do want to address that issue of what is your collateral and what you value it at. Most banks want a lot of collateral, as much as they can get. So, but I do have another video on that goes into more detail. Number 8's the summary. And you try to summarize the loan, the company, how the company is profitable, how the trends of the business will pay off the loan. Summary. It's really a summary of your most important parts of this proposal. And basically, if you have a summary, the bank will read it. So it's a good place to kind of put all your pluses and put them all together and say, this is why you need to make this loan, Mr. Banker, because of all this. You want it to probably be a couple paragraphs. Don't go over a page in length because it may not get read. But anyway, up to a page and a couple paragraphs at least, just summarizing the short loan proposal and summarizing basically all the pluses on it, all the things that are going to show the banker that you can pay off this loan. This is the short loan proposal, and a lot of times the banker will just go ahead and use that to write his credit memo. I've done that before. I've literally taken it word for word, which they'll read it and they'll go, wait a minute, this sounds like the borrower saying this. And I'd be like, oh, sorry about that. And we have I'll change that or whatever. And really, if you give them all of these items, it will basically help them write their credit memo. It will help you get the loan. And they'll do it a lot quicker, too. I mean, a lot of times when they got to pull this stuff out of you and call you back and get more information and everything, I mean, it can take a long time. And maybe the loan isn't that big. So, lenders, they will use your information, especially if it's accurate. They'll use your information to go ahead and write their credit memo, and it'll save them a great amount of time when they do that. It really does. So anyway, this is the short business loan proposal, the new version. And, I look at this version because I looked at the other one, which was my first video, and that's why I did it again, because I was like, that was my first video, and there's a lot of stuff I didn't know. So anyway, I guarantee this will help you. This will improve your chances of getting a loan by at least 100%. I guarantee it. So anyway, thank you very much. If you like this content, if you like, information on lending and businesses and that and all the genre and everything that goes with it, if you would subscribe, and if you hit the notification bell, you'll get notified when I put out a new video. And if you got value from this, I hope you'd hit the like button, because that does help out the channel. So anyway, thank you very much, and I appreciate you watching the whole video, and I'll see you in the next video.